Hi everyone, John Sweet here. Welcome to our first quarterly update for 2026. This is a quarterly call where we try to give clients a sense of what we're thinking, what the last year looked like, last 4 quarters, and what we see coming forward, so that clients have some perspective. So let's start with the economic fundamentals. We'll take a look at the market after that, and then I will have a kind of a closing overview as to what I think you should be taking from this call. So 2025 was actually a pretty decent year in the economy. We've had really 3 years of consistent low but consistent growth in the economy. As we discussed on the last call, the year started on a negative. We had a negative GDP print of negative 0.06, most likely due to the tariffs. But we rebounded very strongly, coming in at 3.8 in Q2, 4.3 in Q3, and the Atlanta Fed and the New York Fed are estimating that GDP for quarter 4 is going to be something around 2.5% to 3%. That is pretty strong. Historically, we've been growing at about a 2% GDP, so to be moving into that type of range has a lot of eyes open. What else can we say about the economy? There is an underlying theme here of weakness, which is very unusual for the kind of GDP prints we're having. Non-farm payrolls last year grew at 0.4%. That's not very robust. That means consumer incomes are not going up with what you would expect, a 3 or 4% GDP print. Secondly, unemployment. Layoffs have pretty much consistently been in the 220 range, but unemployment has risen over the last couple of years. In 2024, unemployment was at 3.4%, and as of November, it had risen to 4.6%. We also have a housing sector that is certainly not doing well by any stretch of the imagination. It's not plummeting, but housing has come down. So it's a little unusual that we have these kind of seeming drags or negatives on the economy, yet GDP is doing well. What can we chalk that up to? It seems to be that this very robust build out in AI infrastructure is probably what we can point to. To me, what we're looking at is a bifurcation between, let's call it the old economy and the new economy. The old economy is let's say it's struggling, it is moderating, while the new economy is forging ahead and growing in a very robust build out. And I think that's probably the dynamic that we're going to be watching this year. Lastly, I want to talk about a paper that I read recently that I think is really helpful, that puts this in context for us. This paper was done by one of the largest companies in the country. They have 100 strategists and 100 analysts. They took 1.5 years to study large technology build-outs, whether it's the railroads, the Industrial Revolution, the internet. And what they concluded, looking at where we are now, was that they placed a 60% probability on the idea that AI is everything that we think it is going to be, and that the economy grows at a 4% or greater GDP for upwards of 10 years. That actually is a very meaningful statement. That is something that we would all want to have happen economically. It means huge positive changes to our economy over time, and most likely a great backdrop for our investments. However, they also painted a picture of a 30% probability that AI either gets postponed for a while, it's not everything we think it's going to be, or it actually really just is a technology that never reaches its potential. And that situation was a difficult economy and a difficult market. During that period, we have, as we all know, a high deficit. The deficit keeps interest rates high, keeps inflation high, keeps growth low because we have to finance this debt. That is not a period where the markets do well. That brings me to the point, why you use us. Financial planning, 40 years, it's always been the most important component to one's finances, because in the long run, the economy, the markets will do well, but you just never know how things are going to play out in the short run. This is a period that I do think is likely to be a wonderful period economically, but it could play out in a very difficult set of circumstances. It could be that AI doesn't take hold for another year, 2 years, 5 years, and then the potential of AI gets realized. And we as investors need to be prepared for that. And that's what your financial plan does. So if you have any questions on anything I've talked about, please email us. But we'll look forward to seeing you again in another quarter and giving you an update on what's happened and where we think we are. Thanks so much.